Welcome back to another Zero DTE podcast, and today we're on episode 23 of season 2, where Ernie talks about maximizing profits. If you're interested in becoming a pro trader, check out the link in the description for a 4-week trial. And of course, as always, enjoy, guys.
How you doing, friends? Ernie here, and this is the final hour show. I'm doing a stand-up show today, meaning that I am actually standing up at my desk. And today's FOMC day. They raised the interest rates by 0.25%, I believe, if I'm not mistaken. Although I didn't even look. I just assumed. I went to the Fed Watch tool. They said, hey, 80% chance they'd do that. So that's what I'm going to assume. Currently, Chairman Powell is in front of the press group, and he's doing a little Q&A. And as typical, when you have a Q&A, you watch the market. It's going up and down, up and down. So it's really all dependent upon the questions that are asked and the answers that are provided. And so currently we're on the downswing. I can only imagine that they're asking questions like, how long is this inflation thing going to go on? And how long is the fight going to be? And will you be able to do very simple things like that? Of course, Powell will be up there making it appear as if they know what they're doing and that they're on track to bring it back down to 2% inflation rate, as if that is some sort of magical number. They just keep on pounding that and repeating that as if they are so deterministic, but they really have not a single clue how they're going to do that or if they can do that. So it's all quite humorous for us here at Zero DTE. Now, of course, none of this really affects our profit-taking strategies here. As a matter of fact, it kind of enhances it because we are anti-fragile here at Zero DTE. And what that really means is that our strategy actually grows stronger in the face of adversity and stressors. So when there's stress on the market, there's increased volatility. That's what we love to see. As a matter of fact, the more the better. And so, in fact, we have trades on right now. Now, whether or not we're going to hit our profit goals, or even get into profit, that's a different story. We don't really play the game like that. We cannot anticipate what the extent of that volatility is going to be. So it's very difficult for us to say, sure, we're going to put on this strategy and it's going to capture all the volatility and we're just going to become rich, as I was going to use a bad word, but I guess you can't do that on a family-friendly show now, can you? So here's the reality of profit taking when you're a premium collector and you're doing Zero DTE. Not every day is a certainty. In fact, only a minority of days are going to turn out really well. And knowing that, we need to set our traps, so to speak, very wide. I like to think of it like being a fisherman that is using just a net and weights to capture his take. And so what we really are doing is that we're just casting that net out there and hopefully putting it into an area where we know fish are likely to be, but we don't know it for sure. And whatever falls into that net, we then bring it in and skillfully bring it in and then get whatever we get. We might get a little, we might get a lot. We don't know. Every day is a little bit different. When we're looking at the Fed day, past Fed days have moved the market as little as 30 points and as much as 300 points. So we really don't know what to expect. Now, the implied volatility, the expected move for today was like 52 points or 50 points, which is really meager. And I think that's because a lot of people had they thought that their expectations were fairly well in line with what might happen. And they may be right. Now, I don't know. Really, I really have no idea. And so what we'll do in response to that is that we'll put on an asymmetric position where we take very little risk. Why take a lot of risk when you really don't know? So we'll take very little risk and then cast that wide net. So it's a lot like the fisherman. We use a very inexpensive net and weights, and the cost of us throwing it out there doesn't expend a whole lot of energy. Now all the work comes in whether or not we can actually capture something and reel it in, right? So that's really what we're after. So in this case, we'll use a butterfly, put it way out of the money, make it as wide as we possibly can, and for as little money as we possibly can do that. Now, generally, on most days, we use something called the 10% rule. Now, the 10% rule is where you'll put on an out of the money butterfly and make sure that the debit is only 10% of the width of one of the wings. And then we would, of course, get the biggest net that we possibly can. In most cases, that's going to be somewhere between a 30 and 40 wide fly per side. So a 30 wide would be a total net width of 60 points, and a 40 wide would be a total net of 80 points. So that's pretty wide, and that's pretty big net to cast, and hopefully that the price will end up there. And it's really a timing game. The timing game is that we have this event that happens at 2 o'clock. At 4 o'clock, the market's going to be closed. Now, there are a couple of things that are happening in between then and then. So we have volatility rising into this event, because that's generally what happens with events like this. And so that's our opportunity to actually lay down the trap or put on the trade, because as volatility rises, that allows us to get the best price possible, the smallest amount of debt for the maximum amount of premium. So that's generally what we're doing. And so we wait for that volatility to rise. We put on the strategy, we put it out as far as we can, and then we just sit there and wait for the trap to be set. Once 2 o'clock comes, there'll be a little bit of churn and everything, because at 2 o'clock with the FOMC, the minutes are released. And with the minutes is generally just, it is actually a textual report. And so all of the AI and linguistics experts are consuming that report, and that's attached to all kinds of algorithms, and it's devised, and then that's set up or set to push buttons on trading programs. And so that goes off, and then once that's done, then volatility starts dropping off. And if we set our trap, then we'll start seeing premium starting to explode inside of these butterflies, and you can collect some profit. If nothing happens, or if the response is muted, then there's really nothing to do. You're not going to get the movement. It doesn't get near your fly, and you just sit there and wait. Now, with an event like today, it's actually two-pronged. So we have that first event potential, but then there's the follow-on at 2:30. There's often and like today, a presser where Chairman Powell will get up in front of the press corps, and then they'll start drilling him with questions. Now, sometimes those questions or the time allotted are very limited, but I think today they need to spend a little bit more time, especially in the shadow of these bank failures that have been happening. And I noticed that just before I came on here, they were asking a lot of questions about that. And so that was interesting. And then just before I got on, they were asking even more pointed questions about expectations and that sort of thing, because people and traders, they base almost all of their investment capital on future expectations. And really that's what they're looking for the Fed to do, is to provide them what a future expectation of the cost of money is going to be. And the less certain that they can make those expectations, the more volatility that there's going to be. So there is a second wind, so to speak, in this event. And I'm looking at the chart right now. Maybe I should bring that up and just show you. So you're looking at the chart right now. You can see that price has dropped. Oh, this is Tesla. All right. Here's the market. So we can see that the presser started at 2:30, which would have been right about here. So it first started right around here. And it was up and down. It initially went down, and then apparently he said some things that the market liked, and it went up. And now it's gone down, so the market doesn't like what he's saying now, so now it's down. And the range since Powell has been on is from 39.72 all the way up to 40.39. So that's interesting. Almost a 70-point range. Well, is that right? Yep, 70-point range, about a 70-point range. So that's obviously at 40% greater than the expected move had predicted, which was only about a 50-point range. So now we can see price going up again. He must have been asked a good question and given a good answer. And now it's going up. It's going to be a roller coaster ride like that. And I don't know. We might end up breaking this session high, or we might end up breaking this session low, or we might end up right back in the middle, which would be probably a big downer for everybody, because then there's no opportunity to profit. So, that's what we are faced with when we're putting on these trades. And so we want to be as flexible as we possibly can. We have no idea where it's going to go. So we'll put on a market neutral, or a market agnostic trade. And with Zero DTE, we have essentially two choices for trades. We have a single fly or a double fly. We call the single fly the classic fly, and that's the classic out of the money asymmetric trade that has using the 10% rule. And that's what we do most days. And well, on days that we feel like there's a good opportunity for catching a trend. These days, recently, it's been the best choice to choose a market neutral trade. And that's where we take two of these classic flies, one above the market, one below it. Then it creates this dual thing that looks like Batman's ears. So we call it the Batman trade. And so that's what we might do here on Fed Day. Put one above, one below, and hopefully one of them will catch the move. Now, when we do that, we have to make sure that our cost is in line, because now we're putting on two flies. Do we want to go with the 10% rule on both of them and then essentially have double the risk? Because we don't know if it's going to go one way or the other. There is an outside chance that we could profit on one and then it comes back and then we profit on the other. That has happened before. And that is typical also with Fed speeches like this, where the market is just going nuts up and down. But I don't know. The answer is that we don't know what's going to happen. So the logical conclusion is to take as little risk as we possibly can. So instead of going to the 10% rule, I might go to a 15 or 20%. Let's see. What I meant to say is the other way around. Maybe a 5%. I was thinking in terms of risk to reward. So instead of, say, going to a risk to reward of 1 to 10, we might go to 1 to 15 or 1 to 20, which would mean that the total amount of risk that we would take versus the spread, instead of being 10%, we might drop that down to 7 or 5 or even 3. So now we're putting on a very tiny. Now what that means also is that we're pushing the flies further out, way out. So the probability of profit is less. And we're taking an appropriate risk for that, pushing them further out. Now, if we're expecting an extreme amount of volatility, even though we push them way out like that, you can still hit it right on the mark. As an example, just a couple of weeks ago, I put on a trade that was 40 wide and only 5% of the total risk, of the total width. So that was a 1 to 20 or 1 to 18 risk to reward. So for every $1, I could potentially make $18. And what happened there is that price did move all the way to the fly and then slightly inside of it. And so for a $200 risk, I received $2,100 in profit. And so that was really cool. Now, when it moves out like that, at one point it was up to $2,700, quite frankly. And that's the point that I'm going to talk to you about, how we actually manage that. But so there you can see that even though a trade looks like it's so far out of the money that there's no way, in fact, on that day, I put up at $200 and made $2,100. Actually, the largest return that I've had so far in this account, this reference account for the service. So it's always possible. Now, here's the cool part. it didn't have to go all the way inside the fly for me to make money. Now, I waited until the market closed and I maximized my result. But had at one point gotten out earlier, I could have actually made another $500 on that trade. When you're in that position, here's the thing. It's like maybe 3:15 in the afternoon. I got 45 minutes left, and it's sitting here right at the edge inside the butterfly, and it's up to about $2,700, as I said. What do? Do I just take the profit? Or do I hang on? Because I've got 45 minutes left. If it just moved another 15 points higher and then stayed there for the duration of the market, I could have potentially have made like $6,000, right? I mean, that actually on each individual fly, it would have been about $3,500, but it was doubled up. So on that small amount of money, I could have made a lot. So there was the potential, if I just hung on just for a little bit more, I could take that 2,700 and turn it into almost 6,500. So I have to make the choice. Well, how am I going to manage this fly? And what we do really is we create a mental trailing stop. And it really is based on where we are relative to the break-evens of the fly or the real-time P&L. And so we're monitoring these things, and also the time of the day. So we have this sort of two-dimensional framework that we use. Now, I'm not going to go into all the particulars, but this is how we manage our trades. We create this sort of multi-dimensional framework, and then depending on what time of the day it is, because we choose different times of the day to break it up, because there's a distinct character to premium decay at different parts of the day on 0 DTE. So we have a different strategy for each one of those days, or a different range of strategies. That's the key. A different range of strategies for different parts of the day. And also we look at the proximity of price to the break-evens of the butterfly and the real-time P&L, because there will also be an additional range of strategies that you can use depending where you are on that profit curve. That profit curve isn't flat. It's this mound, right? And it's constantly growing right into the end of the day until it takes the shape of the fly. So there's a lot of complexity there. Your strategies can be quite nuanced on how you're going to capture the most amount of profit. So that's really what it's about in being a day trader in this, and that's trying to maximize the amount of money that you get, what's available, and assessing the probability of how long to stay in that trade to try to capture that growing mound of premium decay. And so that's really what we do here at 0-DTE. If you're interested in learning how to do that, go down to the description, choose 0-DTE.com/try and take the 4-week trial. Now this all may sound really complex, but once you're into that strategy, it's not so complex. The strategy is something that you will make of your own. You will refine through our continuous improvement process. So there are a number of things going on here. If you want to become a professional trader, it's not as simple as just, say, someone giving you some back-tested strategy and you run that. If that's what you believe, then, or if that were the truth, there would be a whole lot of retail traders out there making a whole lot of money. But the reality is that 98% of you suckers are losing money. And that's because you rely on crap like that. That, you just need the back-tested strategy, you use that, and you apply your risk management, and you make money. There's never been a bigger lie in retail trading than that. So if you want to learn how to become a professional trader, make consistent profits, and then be independent, consistent over the long term, not just maybe 1 or 2 trades here or there, consistent over the long term, become completely independent. So when you know this strategy, it is yours alone. It is something that you'll have for the rest of your life. And then trade at a professional level. And what does that mean? That means understanding all the nuances of a trade like this, having a sophisticated profit-taking strategy like I was talking about, this two-dimensional framework, understanding the nature of premium decay in its different inculcations and the various types of things that you have to be cognizant of, like gamma risk and so forth. So if you want to become a pro, you need to understand that stuff, and you need to create varying strategies that are continually being refined. Because in any one market, here's the other crazy thing. Besides all of these different dimensions of where you could be on that strategy to take profit, that's only for that particular instance in time, in that market, in that volatility regime. The market today compared to a year ago today, completely different. And everything that I said in terms of that strategy, in that framework, would also be different. So you need to also know how to adjust your strategy and make it work. Now, if you think that, oh, I'll just do back testing and I'll get the statistical average, when have you ever known an average to make you money? What do you get with average? You get mediocrity, or you become a loser. Mediocrity means losing. Averages mean losing. There is no winning in statistical averages. And if there were, like I said, all of you jamokes out there that are following backtesting and statistical averages, you'd be making money. But you want to know something? I know that you are not making money. I know it for a fact. I see it every day. I've seen it for the past 40 years in my career. Just watching retail traders just throw money away, believing in a dream in statistical averages. It ain't there. The way you make money is that you have to work at it. You have to know it. You have to develop a strategy and a process, and that process has to be continuously improving. Creating something like that requires training and diligence. And beyond just the training and the diligence, there's a whole nother aspect to this. Your mind has to be sharp, clear-headed, all the distractions away. You have to act like a peak performer, like an athlete. If you don't think that's true, man, then you're missing out. So we take this very seriously here. We talk about peak performance from beginning to end, from the time you wake up to the time you go to bed. Everything that you do in between that time and that time is going to directly affect your ability to profit in this market. That is what a professional trader is all about. And if you want to learn how to do that, as I said, go down to the description down below and take the trial. If you want to believe that it's easier than that, that you can just go and find some back-tested strategy and you'll trade that, fine, go ahead, do that. You'll be back, because I know you're going to be a loser. It's not even like, hey, good luck, I hope you do well. I think that if you really try, you'll do well. No, I know that you're going to go through some sort of ups and downs and you're going to lose. It's a virtual certainty, because the 2% of people that are winning are doing what I'm talking about. The 98% of people that are losing are doing what you're chasing after, a dream. There is no dream. It's hard work, understanding your edge, becoming skilled, developing a process that you continuously improve, and being 100% process focused, not outcome based. That process that you develop is what's going to make you money, that's going to make you rich, that's going to make you independent. Nothing else. Absolutely nothing else. So, anyways, just thought I'd let you know. So I have to get back to this. I've got some profit taking to manage. So, peace to you all. Love you. Again, go down below. Check out the trial. Time for the music.